All right, the time is here. It's 2 o'clock, ready to get going here. Hello and welcome to our webinar today. Our lower price is here to stay. An inside look at the 2014 corn and soybean markets. I'll be your presenter today. My name is Drew Wilkins, and to get us started here, we got to go through a few risk disclosures. So let's get those out of the way here real fast. This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels Ag Services broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Ag Services, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors, such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure assessed at danielsagservices.com. Daniels Ag Services is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Ag Services does not guarantee or verify any performance claims made by such systems or services. All right, so we got the risk disclosures out of the way. Now, to give you a little bit of information about us, as noted earlier, we're Daniels Ag Services. We were founded by Andy Daniels. He's a renowned grain trader, known throughout the trading floors of Chicago. Actually got his start in the cash side of the business as a grain merchandiser. Did that for around 5 years, decided to take his knowledge base over to the trading and brokerage side of things, has businesses here and in South America, and is truly connected throughout the grain trading world. Our motto here at Daniels Ag Services is that we help participants in the ag world run better operations through the futures and options market. All right, so a little bit about me, your presenter. I am Drew Wilkins. That's my picture there to the right. I think that picture was taken in around April a few years ago, and it was after a cold, sunless Chicago winter, and I think my complexion there kind of matches that shirt. But enough about that picture. I'm a senior ag market consultant with Daniels Ag Services and a senior broker with Daniels Trading. I'm also the publisher of the Wilkins Ag Wire, which is a daily video covering what happened in the grain markets the previous day, as well as what we expect to happen for the upcoming trading day. Also a contributing editor at Grain Analyst for the daily report over there. It's my email address, and my Twitter handle is @WilkinsAgWire, and my phone number is there below, and we'll have that information up at the end of the webinar should you need it. So before we jump in any further here, if you have any questions at all, feel free to ask them throughout the webinar. I'm not going to get to them until we are concluded. Just kind of breaks the flow up of the webinar and can take away from some attention here. So I will see the questions that come through. Ask them throughout the webinar, no problem at all. I will answer them at the end. So with that said, let's jump right into the takeaway here. As you might have heard me mention earlier, we're Daniels Ag Services. I gave you a description of what we do there. And we work with a lot of producers and end users over on the Daniels Ag Services side. We're helping with risk management on that end of the side. Well, we also have a leg of our operation here that's called Daniels Trading, and that's more of a speculative side of things, where Daniels Ag Services, we work with a lot of people that are trying to rid themselves of risk. The Daniels Trading side tries to assume that risk and therefore try and make a profit out of it and treats it more as an investment. So, but between those two, we like to have a certain takeaway that we hope our clients have after dealing with us, and that is that Daniels helps me trade and market better because they know ags and give me the flexibility to use the markets however I choose. So that's the takeaway that we strive for our clients to have, and obviously that's a takeaway we want you to have as us as a company, but also we'll have a takeaway today for the 2014 outlook on the corn and soybean markets. So without further ado, we're going to start out with the corn market here. Let's take a look at what we're going to cover today. All right, so we're going to cover where we've been. In the past 3 years, we've had some pretty significant things happen, so we're going to do a brief overview of what we've had happen then. We're also going to go over ethanol, exports, domestic usage for corn, and then last but not least for corn, we're going to cover production. So with that said, let's go ahead and take a look at a continuous corn chart here. So what a continuous corn chart is, for those of you that don't know, it just takes the front month price of corn, and then once it's time for that contract to roll over, it simply just takes the data from the following month, and that's how you get a continuous corn chart. So if we take a look at where we are now, this is where we are now, where I'm drawing right there. When I took this screenshot, we were at 413.5 in the corn market. Okay, so when is the last time we've been at those prices? You got to go all the way back to the third quarter in 2010 to figure the last time we printed 413.5 in a continuous corn chart. So what has happened in between here to cause these crazy prices? Well, obviously we had 3 drought years in a row, and that heavily supported the market. When you have a drought year, the market obviously will trade higher due to the fact that you have less supply in order to incentivize more planting to make up for that lack of supply. So as we have a drought year, we're going to start to trade higher here. You've got higher plantings here in the second quarter of 2011. We kind of fade off, but then we've got another drought year. And then the market kind of settles out for a little bit, chops around, higher plantings, not as bad of a drought, and then the drought of 2012 comes and just substantially higher prices. So we had 3 drought years in a row, really heavily cut into ending stocks, which ending stocks are what you carry over from one year and start off the balance sheet with for the next year. Ending stocks were so low that we had to not only, one, incentivize the market to plant more corn, which obviously when you got $8.50 corn, it's going to make you want to plant a little more, but we also had to do it to kind of spell off some demand. We wanted our corn to be priced very highly in order to incentivize planting, but not only that, to curb some demand. And so the market did its job there. But we move into 2013 here, and we had a pretty good growing season. And you see the old crop prices, these are old crop, that would be considered old crop right there, stayed supported. But once we started trading into September, which is considered new crop, we had a big gap here, and we really replenished supplies in 2013. So the past 3 years we had a drought year. This year, we really did a good job of replenishing stocks, had a great production, great yield, and therefore we're essentially seeing lower prices, and that's why we're back to the levels not seen since the third quarter of 2010. So we kind of covered where we've been. Now let's take a look at where we expect to go for 2013. So let's get these drawings out of the way here. All right, so one of the things that's going to affect where we go into 2014 definitely is the ethanol market. It's been in the news here recently. You might have noticed that the EPA proposed an corn-based ethanol cut of 1.4 billion gallons. So from 14.4 billion gallons to 13 billion gallons. Now that's just a proposed cut. It's nothing that's been formally introduced yet, but it definitely does have an effect on the ethanol market. If you take a look at this chart over here to the left, that red line going across is the 10% of U.S. motor gasoline use, which is also known as the blend wall, ethanol that's blended with gasoline. So as you can see there, in 2012 we've kind of run into it, and there's a number of reasons why we need, or why the EPA is proposing that we need less gasoline. So if you take a look at U.S. fuel usage, in 2008 we were at 145 billion gallons. You have to excuse the misspelling on billion there. Must have got a little excited when I was typing that out. But we were at 145 billion gallons in 2008. Now take a look at the estimate for 2013. We're at 132 billion gallons estimate. So we're using 13 less billion gallons a year in fuel here in the United States. That's due to more fuel-efficient cars being introduced all the time, and also older, less fuel-efficient cars coming out of service. So that's one of the reasons that you see the EPA come out with this proposed cut. The fact is we have less demand for fuel, so therefore it doesn't make much sense for ethanol the renewable fuels to keep on increasing in their production when we're actually needing less and less fuel. So that's why we saw that proposal. As far as the 2014 impact that has on the corn market, we think it's negative due to the fact that when you need less corn to produce ethanol, it throws more supply side in there, and therefore that more supply definitely should have a negative effect on corn prices. So with that said, we're going to take a look at exports now. So one of the main things I want you to focus on here for just a few seconds is the blue. The blue is the United States, and just take a look at this chart here for just a second, focusing on that blue. As you can see, it's been in a steady downtrend here as of late. You look at 2010, 2011, 2012, much lower exports. So this is global corn exports by country. Now, we definitely did have some droughts that year, and it took away from our supply. When you've got less supply, you're going to see prices go up to $8.50. Well, $8.50 corn really ain't going to be that much in demand. So that is a reason. But also, if you take a look at the other colors, the red is Argentina. The green is Brazil. The purple is Ukraine. Those numbers are greatly increasing while we're decreasing. Now, we basically lost our export market dominance where we were in 2007 and 8, we were at 60%. This year, 2013-14, when we've got a decent corn growing year, we're not even at 40%. So the higher prices that the drought years we had incentivized other countries to go ahead and learn to more efficiently and effectively produce corn. So therefore, they became more competitive on the export market. And while we had a heavy grasp in controlling most of the export market, that's no longer there due to the rest of the world becoming, one, more competitive on the export market in prices, and then two, more efficient at growing corn. So we don't see that changing anytime soon. It's definitely not a monopoly on the corn market. There's more competition. Therefore, your prices have to be more competitive on the export market, and that's just where we are now. It'll take a lot to get back to where we have that export dominance, and it's not something that we see happening. So with that said, we're going to take a look here at domestic feed demand. Now, we believe that we're at a generational peak as far as our feed demand. Now, if you take a look at this chart, the orange is feed and residual. The blue is other feed, seed, and industrial. And then the yellow is ethanol. So if you take a look at the orange there, it really has done a good job of hovering around the 5 billion bushel average there. There's been some years higher, especially in when we were hovering around the 6 billion bushel mark in the mid-2000s there. But really, it's been hovering around 5 billion, and we expect it to stay kind of at that pace. One of the things here is the U.S. per person meat consumption is falling. In 2006, it was at 222 pounds a year per person. Here in 2013, it's dropped to 204 pounds per person. That comes from people looking to have less caloric intake due to an aging population, prices rationing demand, and then you've also got people eating healthier, all cutting into meat, and therefore that meat demand, and therefore that will cut into some feed demand. It was kind of in a 5-year downtrend here. So we see feed demand, feed and residual, kind of hovering around that 5 billion bushel mark. So we don't see that changing much. And then the blue, which is the other feed, seed, and industrial, that's pretty much remained constant throughout this whole period from 1987 to 2013. So that leaves us one thing here, and that is the ethanol market. And if you want to take a look at something here, we've kind of been in an expanding triangle here as far as ethanol goes. If you recall what we just went over, we see ethanol demand basically leveling off at where we are right now based on what the EPA is proposing. And unless there is another demand-based driver for corn-based ethanol, which we feel is unlikely, we think that total domestic usage will flatline at best or at worst recede. So we expect this to just kind of hover out there because ethanol should remain constant. We just covered that we think the other feed, seed and industrial will remain the same, and we feel that feed and residual will remain the same. So ethanol is where we think this will have the greatest impact, and we see it flatlining out about kind of where we are right now, if not maybe teetering off a little. So that's kind of where we feel the domestic feed and total domestic corn usage is headed. And obviously that's shouldn't have a huge impact on prices, but should everything teeter off a little bit, like the end of that little line I just drew, it would have a negative effect on the corn prices here. So now let's jump into production here. So we have had sub-trend line yields 4 years in a row. We've never seen 5 years in a row since 1850. So history tells us that we should have an above trend line production this year. But let's take a look at U.S. corn production here. Now, as you can see, grab a little highlighter here. In 2010, 11, and 12, production was way down, especially in 2012. What'd that do? We had higher, and higher prices. Now, where are we in 2013? Around here, we traded up to 850. Now in 2013, we're around 413.5, I believe, is what was on that chart I showed you earlier. Well, it's pretty easy to see why when you take a look at this chart. Corn production this year, the USDA currently has it estimated at 13,843,000 bushels. So when you go from sub 12, sub 11 to almost 14 billion bushels, obviously is going to make a lot of a difference. And let's take a look at the world production here, just to kind of give you another example of how that's done. World production was also down in 2012. So 2012 world production was down, really spiked up this year. It's record production in 2013. So production definitely has been higher, and we expect it to remain high in 2014, barring a big weather or natural disaster. Now, in 2012, we had a drought, and prices shot up extremely high. While if we do have a drought in 2014, we don't believe that we'll see the price levels we saw in 2012, simply due to the fact, if you take a look at U.S. corn production here and world corn production, we've done a great job rebuilding supplies that 3 years of drought years in a row really diminished. So should we have a bad growing year, much like we did in 2012, still don't think that it will catapult prices up to the levels they were in 2012 due to the fact that we're not coming in with such tight stocks like we did to 2012. 2012, we were really tight on corn stocks coming into the year. A drought year did not help that. It compounded it. Therefore, we needed higher prices to curb export demand and also to incentivize more corn planting. And we planted a huge amount of corn acres last year. We had a good growing year, and that's why we had production like we did. So even if we do have a drought, we don't expect it to catapult prices like it did in 2012. So that pretty much covers what we're going to go over today for corn. We gave you a few thoughts on the market there. Now we're going to go over soybeans. So let's take a look at what we're going to cover on soybeans here. One of the things we really want to hit you home with on the soybean market is we believe that the 2013 corn market and the 2014 soybean market are very similar. As we just discussed, coming into 2013, corn stocks were very tight. We did a great job of replenishing them this year. Weather was very conducive. We had great yield, great production. Therefore, we rebuilt supplies. We think that that is the same thing that will happen with the 2014 soybean market. You're talking a lot more planted acres with a normal weather season, much like we had this year. Granted, we had planting delays, hot August, but just shows you how far along we've come along with things like hybrid seed. The crop did a great job of withstanding it. We think if we have the same type of year for 2014 soybean market, the market will act very, very, very similar to the 2013 corn market. And we'll touch over some things on why we think that. We'll talk about China. They're a huge player in the soybean market. We'll go over planted acres, and then we'll go over stock to usage. So much like corn, we're going to take a look at a continuous bean chart here at first. The last time we were at levels where we currently are in the corn market, or in the soybean market, was 2012, first quarter of 2012. So here we are, end of 2013, and the last time we've been at these levels was 2012. Obviously, in 2012, we had a big drought year. Really shot us up high in price. Coming into this year, okay, we're going to have more planted acres, should replenish everything. And then we kind of flatlined here, had a little bit of a planting scare this year. And then good growing year, did a decent job replenishing stocks, although it's not that great. Ending stocks coming in for 2013-14 are only at 170 million bushels. So didn't do just a great job of replenishing stocks as demand remains really high, but prices are still incentivized for producers to go ahead and plant beans. So we had a drought year here in 2012, more of a normal growing season here in 2013. So the last time we've seen current soybean price levels was back in the first quarter of 2012. So that gives you just a brief outlook on where we've been as far as the bean market goes in the past couple of years, 2 growing seasons. Now, let's get rid of these drawings here and take a look at where we think we're going. So China domestic usage remains strong. China's in the process of adding more protein to their diet, much like we're seeing the United States take on less and less protein. We went over the meat consumption there. China is actually changing their diets to add more and more protein. So we need them to continue to have strong demand to support the soybean market. And that's something we don't see changing. I mean, look at this huge uptrend here in this chart. I think we all wish our portfolios looked like this. Hardly a down year. We'd all be pretty happy if that was the case. So that's definitely something that we don't see this trend ending anytime soon. We expect them to continue to have strong usage, which strong usage also, we're going to take a look at the next chart in here, has led to strong net imports. This is a net import chart for China. Now, this tells us a couple of things. It lets us know that their increasing need to import soybeans is pretty much spot on with their increase in consumption. Let's take a little drawing tool here. And this chart is in a clear uptrend. So let's take a look back here at the chart we were just at previously and compare this red line. It totally matches their usage, definitely matches their increase in imports. So this basically tells us they don't really have the infrastructure over there to meet their growing demand needs for soybeans. So we anticipate that their imports will continue to rise. Our use really doesn't change much. If you take a look at the use chart for the United States, crush is inelastic. Our use pretty much remains constant. So exports is the main driver for the soybean demand right now. And we believe that continued imports creates demand for U.S. beans and should support old crop, which will be this year's crop year. We can see that continue supporting old crop until we get some relief from the South American harvest coming up in starting in March. So with that said, let's take a look at planted acres here. Planted acres is one of the big things. Let's get this, erase this drawing here. So U.S. soybean planted acres. This red line I've got right here, I've drawn to establish where the trade thinks we'll have 2014 planted acres. 82 million planted acres. So we had just below a record in 2013. We're looking to have 82 million planted acres for 2014 crop year. Throw on top of that, you got Argentina planting around 50 million acres. Brazil planting around 71 million acres. That's over 200 million acres of beans planted for 2014. So while we are not bringing in very much carryover, as a matter of fact, ending stocks for this year is expected to be around 170 million bushels. That's not much cushion here for the United States. The South American harvest starts in March, and that's really when we think that soybean prices will start to get pressured. That should take some of our export demand down. We have had huge export sales so far for this upcoming marketing year. South American harvest should relieve some of that. Throw on top of that huge planted acres numbers for soybeans, and that's really when we think that soybean prices will start to feel the effect of an expected increase in production brought upon by normal weather and obviously increased planting. So planted acres is a big deal in this. And then also, let's take a look here at U.S. soybean ending stocks versus the stocks to usage ratio. Stocks remain very, very tight. It's not hard to see that. I mean, even the drought years, we're just about 2011 is where we are as far as the ending stocks go. We haven't done a great job of replenishing stocks, and that's why soybean prices have remained supportive to incentivize farmers to plant more soybeans. Based on pre-planting expectations, that's been done. South America has already planted, and they're in the process of doing some planting right now, and they're planting huge acres down there. Here in the United States, we're expected to plant huge acres based on the fact that ending stocks is tight. The market is letting producers know, hey, we need more beans, please plant more, the price incentive is there. So we believe that the ending stocks is going to remain tight until a couple of things happen. Either export demand falls or we increase supplies. We just went over export demand as far as China goes. They're the main player in the soybean market. You don't got to look much farther for U.S. soybean demand than from China. We don't see that going away anytime soon. We feel that that's not realistic to believe that export demand is going to fall. So therefore, we think that number two, increasing supplies, is the most valid option there. We've went over the reasons why we think supplies will increase. South American production plus United States production expected for 2014 should nearly mimic what we had in the 2013 corn market. It should build up a nice cushion, and it should bring prices down to a level to bring a more balanced planting. So we believe that that stock-to-usage ratio in 2014 will be fixed and come in much higher. All right, so we went over a few things in the soybean market. A lot of the things we've touched on today have been more on the bearish side of things, both corn and soybeans. So obviously there's two sides to every market. So let's take a look at a few of the bullish things we've got. And right now, the only thing we see bullish for these markets is weather. So planting issues is definitely something that can support the market. Let's take a look at corn. This is corn this year, and that highlighted blue box shows some decent rallies based on wet planting concerns that we had this past spring. Many of you probably remember the fact that we had planting delays due to heavy rains throughout the Midwest and also in the South this past spring, and that really supported the corn market and extremely supported the soybean market. Look at this nice run up here we got from wet planting weather delays. So even if we do have a great growing year like we did this year, there still has the ability to offer some great selling points or trading points based on wet weather planting delays. And then also another thing to take a look at here is droughts. Let's take a look at the 2012 here. You don't have to be a genius to figure out when the drought took place based on this graph. I mean, just look at this straight line up here. A drought is huge. That's the corn market. Now, as we went over, we don't expect to see the market have this kind of reaction to a drought in 2014 based on the fact that we've done such a good job of replenishing supplies. So we don't see that a line or at quite an extreme price range as we've got here, but it definitely would be supportive of prices if we did have another drought this year. And then, of course, take a look at the soybean market here. Same time period there as to where we just were. Obviously, drought in 2012 took us up very high. If we had a drought like we did in 2012, the soybeans could experience a similar run in prices. We don't think that'll happen, as we went over earlier. We haven't had 5 drought years in a row, so we don't see that being the case. But it definitely will offer some opportunities for more bullish runs to create better sell opportunities if you're a producer, or definitely creates trading opportunities if you are a speculator. So with that said, let's take a quick summary over what we've gone over here. Let's erase this drawing and move on here. All right, so for our summary here, for the corn market, supplies have been replenished. 2013 was a great year for the corn market as far as replenishing supplies and coming in with a solid carryout. That has led us to lower prices, and one of the things that we think that will keep us low is ethanol production is expected to be lowered. It has been proposed, and we believe that ethanol is lowered, and then also export competition. We've got much greater export competition than we've had in the past, so we think less demand for corn for ethanol, and then also less corn leaving the country as exports due to increased competition will help keep prices suppressed. And then we also believe that production will still come up. We're still expected to plant over 90 million acres of corn. If we have above a trend line yield, that's going to put us around 165 bushels per acre average. And if that happens, obviously it'll take normal weather to have a yield like that. Our 2014 harvest price outlook, which is assuming normal weather, is $3.50. So that definitely creates some go ahead and getting some things priced if you're a producer, and then also some trading opportunities if you're a speculator out there. Again, that's assuming normal weather based on the reasons we went over there. So now for soybeans, we see Chinese demand remaining strong here for United States corn. We don't see U.S. usage changing, but we see the 2014 production almost mimicking the 2013 corn market. We're coming in tight. We see a normal weather year coming down the pipe, and we believe that the market will do a great job of, or not the market, but producers will do a great job of replenishing our stocks, having more planted acres, much like we did in corn this year. We're going to have more planted acres in South America, and this should do a great job of replenishing stocks. And with that said, assuming normal weather, the 2014 price harvest outlook, assuming normal weather, is $9.50 based on normal weather. So all right, so we've gone over our 2014 outlook. We've given you where we see prices heading. Now, what can you do about that as a trader or as a producer or as an end user? Well, got to go over a disclosure here, another disclosure based on the NFA webinar and their ID on trade recs being presented in webinars. And because we are registered, and this is a webinar, the NFA has regulations discouraging us from sharing specific trade recommendations with you during this event. However, we do have very specific strategies for both hedgers and speculators based on what we have discussed today. We encourage you to contact us to learn the exact strategies we'd employ based on your circumstances as a trader or producer. And once again, before you enter any trade, you should know and understand the risks of trading futures, options, and spreads. So with that said, we've got to be a little general with our ideas here, but we like being short December 14 corn. Based on our outlook, you're probably not too surprised to see that trade strategy. We've got levels that we like selling at. We think that there are levels that the market will give us great opportunities to get short. Get in contact with us. We'll be happy to go over those with you. And then much like the corn market, we like selling November 14 soybeans on rallies. So we've got specific strategies in mind there as far as points where we think it's good entry opportunities. Can't give those out due to it being a webinar in the NFA's regulations, so just get in touch with us. We'll be happy to discuss those with you. And then that works for both producers and speculators. It doesn't matter where you are on the spectrum as far as that goes. Either one of those we don't think would be a bad idea for you. And then also option strategies. Options are one of the things that are great. They can be as complex as you want them to be, or they can be as simple as you want them to be. Whatever your taste is for on those types of things, we can definitely come up with a strategy that works for you. It's something we do all the time for both producers and speculators alike, and end users alike, as far as protecting themselves or looking to turn a profit if you're a speculator. So get in contact with us. We're more than happy to go over these ideas with you. And as we get going here, if you take a look at this picture and you see in the rearview mirror, it portrays a very clear picture. The trees are clear. The lines in the road are clear. You can see everything clearly. However, when you look forward out the windshield per se, it's very blurry. You've got an idea of what's ahead, but it's not clear. One of the things we try and help our clients do here at Daniels Ag Services and Daniels Trading is help them understand what's happened in the past and give them our opinion on what's going to happen to the future, because we don't know what's going to happen. In the past, it's already happened. If you're hearing something in the news, if something you see a news alert come up on CNBC or Bloomberg or whatever your favorite financial website is, you can pretty much guarantee that that's already been priced in the market, and your ability to take advantage of that move that could have happened based on that news has been gone. We try and keep you ahead and make that road ahead much clearer by letting you know what we think is going to happen and trying to take advantage of it before it's priced into the market. And we always have a motto where we say, we hope that you can say after working with us, Daniels helps me trade and market better because they know ags and give me the flexibility to use the markets however I choose. So with that said, these markets are fun. They're a lot of fun. We want you to have fun, but we want you to stay safe. Much like the Baywatch crew was out there to look out for you should you get caught in the undertow here. We're wanting to help you stay safe. So whether you're looking to us for ideas or you're wanting to trade online on your own, we're here to look out for you, whether that's providing you information on an upcoming report, keeping you abreast of what market moves are going on. We want you to have fun, but we also want you to stay safe. So with that said, how can you stay ahead of the market? Well, there are a couple of things. We got some good offers for you here. Grain Analyst, it's published by Andy Daniels. It's totally complimentary if you're a Daniels Trading or Daniels Ag Services clients. Otherwise, it's $99 a month. One of the main things that we really like about that is it gives you Andy's insider perspectives. It's one of the things that I go to first when I'm trying to stay ahead of the market. It comes straight from Andy's keyboard, and he lets you know what he's looking at in the markets as a speculator, and also what his outlook is for the markets. Because as we said, if it's already in the news, it's already priced in, and we try and stay ahead of it with Andy's insider perspective and then also the trades that comes from it. And then we've also got the Wilkins Agwire here. It's published by me. It comes at daily video with some occasional extras. If I see something in the market, I will email it out to let you know. That's free. You don't have to be a client to sign up for that. You can find that on our website. We'll also get you some links out to these two things and a follow-up email. So we think that these two things definitely give you the ability to stay ahead of the markets here and really take advantage of opportunities in the upcoming 2014 corn and soybean markets. So with that said, we got to go through a couple more risk disclosures here. So if you could just take a second and read these. Well, we're just going to go through these here real quick. All right, so thanks for taking a second to go over those risk disclosures again. Now we'll go over some questions. We got one question here from James. Is it possible to be sent a copy of this presentation? Yes, this has been recorded, so you will get a follow-up email after this presentation that will have information on how to sign up for Grain Analyst, the Wilkins Agwire, and a link to where you can watch a recorded version of this presentation. So thanks for your question there, James. All right, let's see here. What other questions do we have? Okay, we've got another one here, and it says, do we really see ethanol demand stabilizing or reducing? Yes, we definitely do see ethanol demand stabilizing or reducing. Actually, the EPA, with its proposal, has reduced it from we had 14.4 billion gallons to 13 billion gallons. So we have a 1.4 reduction proposal on the table right now. So if you recall the chart we went over, it definitely went from being a solid uptrending market. Let's take a look at that real quick again. Let's see here. So let's go back to this chart. I believe this is all right, so this is total domestic use. As you can see here, we definitely had an uptrending market in ethanol. We expect the ethanol to level off and then slowly go down. So You've got the other FSI not changing. Feed and residual we think is going to be coming in steady around 5 billion bushels. So we think that ethanol is the only thing that's going to influence change in U.S. corn domestic usage in the near term. So that's definitely something you can keep your eye on. And one of the things I think we didn't touch on over this is you can make ethanol out of natural gas for 70 cents a gallon. Compare that to corn, it costs $2.50 a gallon. Now, the farm lobby is very strong and has a solid outreach in Washington, so we don't see that that impeding too much the natural gas over corn-based ethanol anytime soon. But it's definitely something to keep your eye on. The farm lobby is strong. We don't see it happening. But should the government decide to take a further look into the natural gas as that side, we definitely could see that impacted as well. So, all right, we've got another question here. Is it possible to have the Wilkins Ag Wire delivered straight to my email box? Yep. If you sign up for it in the follow-up email, it'll come straight to you as an email every day. So it definitely will, John. Then Roger says here, remember the ethanol proposals are minimal amounts the market can use as much as it wants. That's a very good point, Roger, and that's why we don't see this really teetering off too much until much further down the road. We think that we'll kind of stay around this the total corn domestic usage around the 11 billion bushel mark. So you are correct there, Roger, and that was definitely a good input. So we'll see. We'll wait a couple more seconds here to see if we have any more questions trickle through here. Otherwise, we'll wrap it up. That's a good question there, Daniel. Which do you use in your hair, corn oil or soybean oil? You know what? I don't know what it's made out of. I got to do something to get it look like that a little bit, but I like that. That's good. Thank you. All right, well, guys, doesn't look like we've got anything else coming over. I really want to thank you for attending. Appreciate you making time for us during the Thanksgiving week here. I know things can get hectic with family coming in town or traveling, so thanks for taking the time out of your schedule to join us for this webinar. We'll actually be represented here in a couple weeks, so if you've got an interest in coming back and taking some time out of your day to spend it with us, definitely do that. We'll also get you the archive version if you want to watch this. If you might have missed something or have a question over something I went over, feel free to get in touch. Happy to take the time to talk with you about this. So thanks for tuning in, and have a great day and a great Thanksgiving.